A. Define working capital and identify its components. Working capital represents the funds a company uses to support its short-term operations and day-to-day activities. It reflects the firm's ability to meet short-term obligations and maintain operational efficiency without financial strain. The primary components of working capital are current assets and current liabilities. Current assets typically include cash, marketable securities, accounts receivable, and inventory. Current liabilities include accounts payable, accrued expenses, short-term debt, and other obligations due within 1 year. Effective working capital management balances liquidity and profitability. Excessive investment in current assets reduces returns, while insufficient working capital increases liquidity risk. Industry characteristics influence working capital structure. Manufacturing firms often carry higher inventory, while service firms rely more on receivables and payables. Understanding working capital components is essential for liquidity management and financial stability. B. Calculate net working capital. Net working capital, NWC, is calculated as current assets minus current liabilities. A positive NWC indicates that the company has sufficient short-term resources to cover its short-term obligations. A negative NWC may signal liquidity risk, although in certain industries, e.g., retail with fast inventory turnover, it may reflect operational efficiency. Changes in NWC affect cash flow. An increase in current assets, other than cash, or a decrease in current liabilities typically reduces cash, while the opposite increases cash. NWC trends over time provide insight into operational performance and liquidity management. Rapid growth may require additional working capital financing. Accurate NWC calculation supports short-term financing decisions and financial planning. C. Explain the benefit of short-term financial forecasts in working capital management. Short-term financial forecasts project expected cash inflows and outflows over upcoming periods. They help managers anticipate liquidity shortages or excess cash balances. Forecasting supports proactive decision-making. Companies can arrange short-term financing, adjust credit policies, or manage inventory levels before liquidity problems arise. Cash budgets are a key forecasting tool. They estimate collections, payments, and financing needs on a monthly or quarterly basis. Effective forecasting reduces reliance on emergency borrowing and improves relationships with creditors and suppliers. By improving visibility into short-term needs, forecasts enhance operational stability, reduce financial risk, and optimize working capital efficiency. D. Identify and describe factors influencing the levels of cash. Operating cycle characteristics significantly influence cash levels. Companies with long production and collection cycles require higher cash balances to fund inventory and receivables before customer payments are received. Cash flow volatility affects precautionary balances. Firms with unpredictable inflows or seasonal sales patterns maintain larger cash reserves to avoid liquidity shortages. Access to credit markets reduces the need for holding excess cash. Companies with strong banking relationships or revolving credit facilities can operate with lower cash balances. Payment practices and supplier terms impact cash requirements. Favorable credit terms reduce immediate cash needs. Management's risk tolerance and investment opportunities also influence optimal cash levels. E. Identify and explain the 3 motives for holding cash. The transaction motive refers to holding cash to meet routine operational needs. This includes paying suppliers, wages, taxes, and other recurring expenses required for daily business activities. The precautionary motive involves maintaining cash reserves for unexpected events. Economic downturns, sudden expenses, or revenue shortfalls justify holding additional liquidity. The speculative motive reflects holding cash to take advantage of unexpected opportunities. Firms may use excess cash to acquire assets, invest in projects, or respond quickly to favorable market conditions. Balancing these motives ensures sufficient liquidity without sacrificing profitability. Effective cash management aligns these motives with corporate strategy and risk tolerance. F. Prepare forecasts of future cash flows. Cash flow forecasting estimates expected cash receipts and disbursements over a specified period. It is typically prepared through a cash budget that outlines inflows from sales collections and outflows for operating and financing expenses. Forecasting requires analyzing historical trends and anticipated business activity. Credit terms, collection patterns, and seasonal fluctuations must be considered. Short-term forecasts help manage liquidity and borrowing needs. Long-term forecasts assist in capital planning and strategic financing decisions. Scenario analysis enhances forecast reliability. Managers evaluate best-case and worst-case outcomes. Accurate forecasting reduces financial risk and supports proactive working capital management. G. Identify methods of speeding up cash collections. Accelerating receivables improves liquidity and reduces financing costs. One common method is offering cash discounts for early payment to encourage prompt collections. Lockbox systems speed up the collection process. Customers send payments to a bank-operated post office box, reducing mail and processing time. Electronic funds transfer (EFT) and online payment systems shorten collection cycles. Automated clearing improves efficiency and reduces administrative delay. Factoring allows firms to sell receivables to a third party for immediate cash. Although it incurs a fee, it enhances liquidity. Effective collection strategies reduce days sales outstanding and strengthen overall cash management. H. Calculate the net benefit of a lockbox system. A lockbox system accelerates cash collections by reducing mail, processing, and clearing time. Customers send payments directly to a bank-managed post office box, where deposits are processed immediately, improving availability of funds. The net benefit is calculated by comparing annual benefits to annual costs. Benefits equal the daily reduction in collection time multiplied by average daily collections and the firm's opportunity cost of capital. Costs include bank service fees and administrative expenses. These must be subtracted from the annual financing savings that if the present value of benefits exceeds costs, the lockbox system is financially justified. This analysis reflects time value of money and supports data-driven liquidity management decisions. 1. Define concentration banking. Concentration banking is a cash management system that centralizes funds from multiple locations into a single primary account. It is commonly used by companies operating in multiple geographic regions. Local collection centers deposit customer payments in regional banks. Funds are then electronically transferred to a central concentration account. This system reduces idle cash balances across locations. It enhances control and improves investment or debt repayment efficiency. Electronic transfers accelerate fund availability. This reduces collection float and strengthens liquidity. Concentration banking improves cash visibility and facilitates centralized treasury management.